Welcome back to our podcast on the house. This is going to be our last podcast for this year. So, we are going to give you our predictions for the housing market for 2026. My name is Reena Agrawal, and I'm a senior research economist at Veros Real Estate Solutions.
And my name is Eric Fox. I'm joining Reena today. I'm the chief economist at Veros Real Estate Solutions.
So, my first prediction for 2026 is this is not going to be the comeback year that buyers have been waiting for in terms of affordability. So, affordability has been strained for the last few years. Home prices have grown rapidly. In fact, since early 2020, home prices have increased by more than 50%. But incomes have not kept pace. Income has only grown up by around 29%. So there's this huge divergence between home price growth and income growth. But 2026 is shaping differently. We expect home price growth to be little less than the income growth. So for that part of the equation, buyers will find some relief, but this relief is only going to be very modest, very marginal, because don't forget the past few years of those huge home price growth. So there is not going to be any reset to pre-pandemic affordability either. And a related aspect of affordability is the employment situation in the country. We expect unemployment to actually tick up going from here. Right now, it is around 4.4%. We expect it to tick up to 4.6% by the end of 2026. In particular, the professional and business services sector, which is home to a lot of high income earners, that drives home buying activity. Here, hiring has become slow. In fact, there have been a lot of layoffs also. So from that perspective, demand for homes is going to be low. From the income perspective, another facet of affordability is the mortgage rates. Again, we expect mortgage rates to remain sticky, even though the Fed has cut rates 3 times this year. We don't expect mortgage rates to go much lower. So, the average mortgage rate in 2026 is going to be slightly lower than what it was in 2025. So that will provide some kind of relief to home buyers. But then the rise in home prices is going to kind of counterbalance that and not have much of an impact on the monthly payments. Another factor related to mortgage rates is the idea that some policymakers have been talking about, which is the 50-year mortgage rate. So there's the idea that if the loan is stretched out from 30 to 50 years, that is going to lower the monthly payments so more people can afford a house. But I don't think this is going to take off either, because this lowering of monthly payments by 10 to 12%, it's going to come at a huge cost. And that huge cost is that interest payments over the life of the loan will almost double. So I don't think it's sound financial advice to go into a 50-year loan. So when we're talking about affordability or lack of it, given the sticky mortgage rates, given the home price appreciation of the past few years, given the uncertainty about unemployment and whatever, I don't think there is going to be much impact in terms of affordability. There won't be much relief to home buyers.
Well, unfortunately, I hate to lead the predictions with a gloomy prediction, I guess, but at the same time, I'm honestly not surprised that you would have that prediction. So I'm going to, maybe for the second prediction, keep in the spirit of the comment you just made about mortgages. And I too agree with you that I don't think the 50-year mortgage is going to take off. It's a great political soundbite, perhaps, but I don't see that as being viable as an alternative to, say, the 30-year or 15-year fixed rate mortgages. Interestingly, though, I was having a conversation with some friends of mine who live in Melbourne, Australia, and they were commenting to me that all of the mortgages they have in Australia are, they call them fixed, but they have adjustment periods, which sounds like an adjustable rate mortgage by our definition. All of the homes have that. And so it seems to me one of the things we might be seeing a ramping up of in 2026 is the use of adjustable rate mortgages to finance homes. And by that, I don't mean where you have 1 year that your rate is fixed and then it adjusts in a year. That's just too risky. I think more of the stable 5-year lock-in periods, and then it adjusts in 5 years at another rate is more reasonable. So that gives homeowners the opportunity to start with a lower payment, and it gives them 5 years then for their incomes to rise. And sometimes the rates adjust down, to your point. If rates come down slightly, if they continue to do that in 5 years, the adjustable rate would come down. Or they may move, or they may refinance to something else. So I don't see a lot of use of adjustable rate mortgages given the current scenario. And if we go back in time and look at a similar scenario, when adjustable rate mortgage use spiked, it was right around 2006, 2007. And during that time frame, adjustable rate mortgages usage was about 30%. And what was going on during that time? Well, what was going on during that time is house prices were very high. We remember the kind of the crisis we had due to lax lending standards, and everybody was buying houses and the prices soared. Interest rates during that time, everybody was doing an adjustable rate mortgage because they were going to hold it for 6 months and then flip it and sell it for 10% more. So that was very popular, and 35% of the mortgages during that time were adjustable rate mortgages. Well, if we stop and look at what we have now, it's very similar. Back then, fixed rate mortgages weren't that expensive either. Just like now, they are not historically expensive, but prices today are very, very high. And so when I was looking at just some differences, if somebody today were to take an adjustable rate mortgage versus the corresponding fixed rate mortgage, so if you put 20% down, your principal and interest today for a 30-year fixed mortgage would be based on an interest rate of about 6.3%. If we look at the corresponding 5/1 adjustable rate mortgage, it currently runs about 5.5%, and your principal and interest would go down about 10 or 12%. Now, is that dramatic? No, it's not dramatic. But where buyers are sitting on the sidelines saying, hey, we cannot afford this house, our income needs to grow by 10 or 15% to be able to afford the monthly payment, I think this is going to start to be an attractive option for many people. And one of the things you might ask is, well, what percentage of the mortgages that are originated today are adjustable rate mortgages? And the answer is only about 5%. And so I can easily see that, like it did in the 2006, 2007 timeframe, I can easily see that ramping up, and we could approach something, nothing like we had back in 2007 of 30, 35%, but I certainly think we could see something above 5% that we have today. So I wouldn't be surprised in 2026 to see adjustable rate mortgage usage increase to 10, 15% of originations to help buyers with eke out that little extra bit of affordability.
So I agree with you there that adjustable rate mortgages are going to ramp up. And you mentioned that 5.5% interest rate on a 5/1 ARM. So because my third prediction is kind of based off of that, we are predicting that mortgage rates will average 6.2% in 2026. So that is going to remain higher than the adjustable mortgage rate. And even though the Fed has cut rate 3 times this year already, the Fed cut rates 3 times last year, but we have not seen a corresponding decrease in mortgage rates. And that is because mortgage rates depend on the 10-year Treasury yield and also expectations about inflation in the future, expectations how the economy will perform in the future. So based off all those factors, mortgage rates will be 6.2% next year. That is, of course, slightly lower than the 6.6% average we saw in 2025. And this will definitely lower mortgage payments slightly, but not by a whole lot because home prices are also going up. So what this means for home buyers, in my opinion, is some home buyers will probably find it feasible to buy that house, but only some, not a whole bunch. Other folks, like you mentioned, they might be able to refinance those who bought a home above 7% or whatever. So it might be beneficial to them. But overall, if you see the large picture, there is not going to be much relief on this front either. So this is my third prediction for 2026.
Okay, so you don't see rates going up, but you certainly don't see them going back to below 5% like we had during COVID.
Yes.
Okay. Well, again, not a surprise, I guess.
Yes.
That is your forecast. So I'm going to have a forecast about people and buying. And my forecast is going to be people are going to just be tired of sitting on the sidelines, status quo, and sales are going to go up modestly in 2026. And by modest, I don't mean doubling or 50% increase. I mean sales over 2025 will be up about 10% in 2026. And so why is that? What are people doing today that they're just going to suddenly tire of? Well, we see that a lot of people are renting today. They say they want to wait until the housing market just finally, they can afford it. Well, a lot of people don't want to rent forever. So they're going to say, let's just this year move. There are a lot of people perhaps that say we want to start our families, but we can't do so in this small 1-bedroom condo. We need to move to a 3-bedroom or a 2-bedroom home. So they're going to say we can't just like put our life on hold for 5 more years until the housing market completely unthaws. They're going to get tired of it and want to move forward. So I think we also have had a lot of folks that are sitting on their 3% interest rate. We can't ever move because we've got this killer 3% interest rate. And I think people are going to start to say, you know what, we do want to downsize. We do want to retire. We do want to move to Florida or Arizona or Las Vegas to retire. Even though it is going to cost us a little more, even though we're not going to get as much for our money. We've been in a holding pattern here now for 4 years, and it's time to move on with our life. So we want to continue to do that. We don't want to continue living in the 5-bedroom family home that we've lived in for 30 years. So I think that is going to set the stage for modest increases in sales from people just saying, I'm tiring of this. That doesn't necessarily mean big increases in prices. But I think we can start to say, we will look and say, okay, 2026 was the year when the markets started to thaw a little bit. Not dramatic. I don't think we're going to see anything like during COVID in 2021 where prices soar. But I think we will see sales definitely perk up a bit. And I'm going to estimate 10% year over year.
That is excellent. I think that's good news for the housing market. Okay. So my fifth prediction is that 2026 will be the year of two housing markets. Typically, we talk about the housing market as one entity, but I think it has been region specific for a while here, and it's going to continue to be the same in 2026. Depending on where you live, if you live somewhere in the Northeast or the Midwest, you're probably seeing a strong housing market. You're seeing steady demand, homes staying on the market for fewer days. Whereas if you are perhaps living in the Sun Belt, in the southern states, or in the western states, you're probably seeing homes staying on the market longer. You're seeing homes not moving so fast. So it really depends on the supply and demand for a specific region, for a specific metro. So if you are in the Northeast or in the Midwest, in places like upstate New York, for example, or metros in Connecticut like Hartford, or some towns in Ohio or Michigan or Indiana, you're seeing that homes are moving fast. There is limited supply and prices are rising. So what happened is these metros did not experience those enormous price run-ups during the pandemic that many other metros saw. So now when we are looking at constrained affordability across the country, now these metros look affordable, relatively affordable. So, and also these metros are offering a stable economy. There are jobs across various sectors. People who have been priced out of coastal cities or the Sun Belt, they are choosing to move here because they find because they're finding homes more affordable here. Now, in contrast, if you look at some of the metros in the Sun Belt, let's look at Tampa or Austin, then you are seeing that the housing market is cooling here. Why that is happening is because during the pandemic years, these metros saw exploding demand. There was very short supply. Homes were moving very fast. Also, what was happening is builders started constructing here big time. So now what has happened is home prices have risen so much that many folks are finding it unaffordable to live here. Also, migration to these cities has slowed down. During the pandemic, folks were moving out of these urban hubs because they could work remotely. And now, because of the back to office policies, they have to move back, right? And also there is a lot of construction happened here. So supply is there. Also, there are additional costs in terms of home insurance that has gone up big time. HOA fees have gone up big time. Property taxes have also increased. So when you add up all these costs, these centers, these pandemic boom towns are now weakening. Austin is a great example of that. So also when we talk about supply and demand specific to a particular geography, if you look at the Bay Area in California, if you look at San Francisco and San Jose, the AI boom is now creating high-paying jobs, which naturally leads to more housing demand. So there are pockets where the housing market is strong. There are pockets where the housing market is weakening. There are pockets where the housing market is steady. When you look at the overall picture, it seems that the housing market is frozen. But even though it looks frozen, there is a lot of pent-up demand, I feel. There are many millions of households that do want to buy a house, but I think what they want is a little better affordability. They want a little better supply of starter homes. They perhaps want a little more job security. So I think once these pieces start falling into place, the housing market will get unstuck. But right now, if you're talking about any improvement in the housing market, it's going to be modest. It's just going to be marginal in places. So it's going to remain very regional in 2026.
Okay. Very, very good prediction or interesting prediction. So the last and final prediction that we have for today, I decided that I wanted to do one about population growth and how that was going to impact the housing market in 2026. So my prediction is that population growth will slow. And as population growth slows, that's going to result in less competition for the scarce inventory, which again is going to help thaw the housing market, and this in turn will help contribute to that plus 10% increase in sales year over year that I'm predicting. So why do I forecast that population growth is going to slow? So I looked at some statistics, and they're very I want to say startling when we see the numbers. So first thing is if we look at birth rates, so that is the number of births per 1,000 people. So if we go back to the 1950s in the United States, there were an average of 25 births per 1,000 people. This was the period when the baby boomers were born after World War II, but before the 60s. So that is kind of, we know, a high water mark, but that's a good mark for comparison. By 1990, that number had gone from 25 down to 17. So not drastic reduction, but still a bit of a reduction. When we go to 2000, that 17 had gone down to 15. When we go to 2010, that 15 had gone down to 13. And today, that 13 has gone down to 10. So it's plummeted compared to what we saw during the baby boomer time frame. So this is continuing. And I think that this is one element that we are going to continue to see with that. The second thing, as the baby boomers age, aging population means more deaths. That likewise is going to cause the population growth to slow down. So if we look at the deaths per year in the United States between 2000 and 2010, that number was about 2.2 million people. Now, of course, the population is growing, so a larger population is going to have a few more deaths than a smaller population. But by and large, the population in the United States back in 2000 is very similar to the population today. So 2000 to 2010, it was 2.2 million deaths per year in the United States. In 2020, it was 2.7 million deaths per year. This year, it's estimated to be 3 million. And in the next 20 years, it's supposed to ramp up to 4 million. And so this is very predictable because just projecting out existing known ages of the population according to actuarial tables. So these tend to be very accurate predictions, even though we're looking out 20 years. But both of these things together are going to slow growth, slow population growth. And also, I think we have external policy-related items going on now with more scrutiny on immigration. That's slowing down immigration into the United States. How long in the future those policies are going to remain in effect remains to be seen, but certainly in the near term, I think it's reasonable to assume that they will remain in place. So that adds to that. So all of the things added up together, I think, are shaping up for 2026 to have population growth slowing in the United States. That's going to result in less competition for the scarce resources. So again, that'll give a little bit of a boost to the housing market.
I think I'm going to throw in one final prediction for 2026, and that is the home price forecast. Our preliminary calculations show that it's going to be around 1 to 1.5%. We will see some declines in some metros. Those declines will be small. We will see some price appreciation in some metros. Again, there will be small single-digit increases, and then there will be other metros where prices are going to move sideways. So those are our predictions for 2026. Thank you for your insights, Eric.
Well, and thank you, Reena. And we will have to make a point in December of 2026 for our last podcast of 2026. We'll have to go back to today and see how we did.
Thank you.
Thank you for joining.